Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, so now how do I capitalize on those scenarios? Absolutely. From a trend trading standpoint, I don't have to abandon my options at all. In fact, what I'm going to be doing is the same way I would be looking to position myself in the underlying swing trade. I'll be doing that same thing on my YUK or my EUI or my CDD or BPX. I'll do the same thing on the correction. So in an up, let's pick a. Is there any particular chart you're looking at there, J. Paul? Pull that particular symbol up, and we'll do some hard and fast analysis right here.
He's looking at EUI.
EUI? Okay, no worries. So I'm going to pull up the $ EUI, and here, okay. So any particular time frame, I can pull up a 240 or. If we're looking at an uptrend, look at a 240 or a 180. So if I'm looking at, say, a longer-term intraday time frame, like the 240, now I don't really necessarily believe, and this is just something I need to put out there, I don't necessarily believe that this is a really strong established uptrend on the daily. So if I'm looking at playing swing trades, it's not necessarily going to be on the daily. If anything, I'm going to be looking for puts around 71.50, 72 on the EUI.
Or maybe even... Raghee, even if it breaks out, because a lot of people are going to get excited, you would tend to maybe play the other way. You know, let's say if it gets up to 72.20 or 72.30, some technicians would be very excited. But you don't think that this has a lot of legs, this rally coming up, the next one?
Well, you know, if I'm looking at what the dollar's doing, the only reason we would break 72 is if we find support and breaks 80 on the dollar index. And I just don't know how likely that is. So at some point, I need to pick a side and use my analysis for what I feel is the most likely scenario. But if we do break 72, head up to 72.20 or 72.50 on the EUI, you know, here's the flip side of that. If I feel the momentum is shifted, then I've definitely got myself in a position with the option where I do have some staying power. With the spot contract, I may not want to. With the options contract, I know my risk is limited, and I'm not necessarily in a position where at a certain percentage or dollar amount or support or resistance level, I'm going to be stopped out. I actually have some staying power because I know that the ultimate extent of my risk is going to, you know, be the cost of that option. So that's a tremendous, you know, when you're picking tops and bottoms, talk about being able to sleep at night. You know, that's you know, my take. So I would have some staying power with that put at the EUI. If I'm looking to follow the trend, though, and let's say that in this case we're looking at an uptrend on the 240, what I would look to do is buy calls on pullbacks. So I would love to see a pullback in the EUI, which would mean a bounce in the underlying spot in the euro-US dollar, bounce in the context of that downtrend. So if I can get that pullback here, say to anything below 71, here's where options shopping helps. Right now, what I would recommend you do, and this is for everybody, pick the strike prices that you're comfortable buying. You might have 3 or 4 different strikes that you'd like to own. Look at them within the context of, I don't know that it necessarily goes October, but price them out in October, November, December. Get an idea of what you're going to pay for those strike prices depending upon your expiration month. That's the first step. You know what you're buying. We would you know, shop around for cars. We're going to shop around for our options too. So get an idea of how these things are moving with the underlying movement of the pair. Now what I want to do is ask myself, how much time and how much can I afford? Because, you know, the amount of capital you're going to dedicate to one of these positions is going to really vary for all of us. Some of us might be very comfortable with a lot of time and a fairly nearby strike, while others of us are going to say, hey, I don't have that much to put to this position, but I can still get this option to work for me by maybe going a little further away from the money, but giving myself time. And that's always going to be my preference for longer-term time frames like a 240 or a daily. So again, it's really going to depend upon which time frame you're trying to capitalize on, because the pullback on, say, a daily or the pullback on a 240 is going to be much larger than the pullback on a 30 or the pullback on a 60. So depending upon the amount of pullback we're looking at, you might want to focus in on that time frame, knowing that if you get a pullback to say 70.55 on the EUI in a 60-minute chart, that's a great pullback. That's great support, both in the wave and psychological number. So, there's so many things you need to balance, but guess what? These are the same things we'd be balancing if we were trading the underlying pair. So what I'm here to say is you don't have to change your strategy. You don't have to change your approach. You probably already know the lines and levels you want to engage the market at, these decision levels. Now the question is, are there ways to better do it with an option? And most of the time, that answer is yes, as long as you're not paying for the volatility. And what you're doing in the context of this correction is you're buying a call while the market's heading down. You might be paying for a little bit of volatility, but at least you're taking that option in when the market's coming in. And in that way, you're probably getting a better deal, if you will, in the most basic way.
Raghee, we got to take one or two more questions.
Sure.
We're running out of time, but here's a question from Kishore, and this is a really good one, I think. I mean, I know I go through this in my own account. When you think about trading from a contrarian standpoint, you say, all right, well, the market's right now, AUX is obviously moving up, so the U.S. dollar is rallying. And the question is, well, how about if I scale up my put buying? Because I really think the Aussie is going to actually get strengthened. That or the attendee feels that the general economy is going to strengthen, and so commodities will improve over the next couple of months. What about scaling into some put buying, even though we look at the chart of AUX and we see tremendous strength for the U.S. dollar? How would you play that?
So the question is getting long the AUX?
No, I think the attendee saying, they're actually bearish on the U.S. dollar.
Oh, okay.
How would you feel about scaling into some put buying? Pick a strike and buy 20%, or I'm just picking numbers, 30% at a certain number, buy another 30, 40%, another 30. Scale into your put buys, thinking that the U.S. dollar will weaken. Do you ever really get into that kind of strategy where you just sort of scale into your position?
Well, I think that at some point we need to have an understanding of when that analysis is valid. So I don't want to go off a hunch, and I don't want to go off any kind of feeling of, and by the way, I do agree with the 10D. I do think the dollar is going to weaken, the dollar index. Here's a chart of the AUX and the dollar index overlaid. I do think the dollar index is going to weaken, like I mentioned, up near that 80 level.
Right.
So I don't want to just hop into a position and continue to scale without an understanding of validity. So in this case, I do agree with the underlying belief that the scaling in or the position for some puts in the AUX is justified because of the fact that I feel that the dollar index is going to top here. Same thing could go for the same thing could go for any market that I feel I'll be able to get a good correlation to with the dollar. So would the AUX be my first choice in that thinking? Probably not. I'd probably be looking at the EUI, and I'd be looking at options in the SFC. Now remember, the SFC is going to be more sympathetic when you look at the dollar Swissy. It moves in sympathy in terms of directionally with the U.S. dollar index, while the EUI, meaning the spot on the euro-U.S. dollar, is going to move inverse. Now here you see the EUI and the dollar index. So the reason I'm doing these overlays, gang, is so you don't get lost in looking at the EUI and then looking at your euro-U.S. dollar on whatever Forex platform you have and saying, wait a minute, where's my correlation?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.